Welcome to Investing. I'm delighted to be here with you again. My name is Mentor Ate, and in today's session, we're going to be talking about what I consider to be some of the, you might call it secrets. That's a catching phrase or word, but in truth, there are no secrets to investing. There are no secrets to making money. There are no secrets to wealth. If you study, what you find is that the principles go back as long as recorded history began. But I want to talk about some of what a lot of people consider to be the wealth and investing secrets in relation to property investing and real estate. Now, if you're joining for the first time, you've met us today in a series we started a number of days ago talking about investing, and we are still dealing with one of the investment vehicles, property investing, or what some people call real estate. And we will be coming to the end of this session of real estate perhaps within the next day or two, and then we can move into the next investment vehicle. But in today's session, I'm going to be talking about four key what I consider to be fundamental principles that should be understood if you have an interest in investing. Like I've said a number of times since we started this series, investing in itself is an intellectual game. In other words, it requires a lot of knowledge and understanding and wisdom. It has less to do with using your gut feelings, it has less to do with using your instincts, and it has less to do with using your emotions. It has a lot more to do with making the right decisions. And the best investors normally are those who do all of the thinking before the decision is needed to make a deal or to make either a selection from a choice of various options. You do your thinking beforehand, so that when the time comes to make a decision, your decisions are not emotionally biased or influenced. Now, in today's session, the first that I want to talk about is a concept in real estate. Anyone who is into real estate investing perhaps understands this concept. It's the concept of appreciation. Now, the purpose for investing is to create wealth. And the purpose of investing is simply to acquire assets and investments that appreciate in value. So what you have is really an asset. An asset is something whereby after the original capital investment, it appreciates in value. In other words, it increases in value, but also it creates an income. That is what I will call an asset. Now, I should clarify by saying that there are some assets that will appreciate in value, but may not create an income. Now, let me give you a good example so you see how this applies to real estate. Now, if I buy a piece of land, assuming I have a piece of land in central London, let's assume that piece of land has a value of £1 million. Let's also assume that piece of land, I intend to keep it for a number of years. Now, potentially, if we assume that in 5 years, that piece of land has appreciated to maybe 1.2 million, then it's gone up in value. That piece of land normally, if it has nothing on it, assuming it's just a bare piece of land, there are no buildings, then it would mean that piece of land is not generating any income for me. It is an asset. In other words, there is some value in it and the value is increasing. The challenge and the difficulty with that piece of asset is, unfortunately, my assessments are based on opinions of the future. In other words, because I'm not selling the piece of land, I'm still making an assumption. In yesterday's session, I talked about a concept. The concept that I talked about was the difference between what's a fact and what's an opinion. So the piece of land is still an asset. It has some money of value in it. It's not depreciating, it's appreciating, although that is an opinion. However, if I have the same piece of land, or in this instance, let's just say I just own maybe an apartment complex on a building site. Let's say, for example, I own maybe 2 floors of apartments in a building. I don't own the land, but I own the apartment buildings. Let's assume these apartment buildings are also worth a combined estimate of £1 million. Let's also assume that in 5 years' time it will appreciate in value. The same principle will apply to the piece of land. However, if this piece of property is something that I'm renting, then it generates an income for me whereby I have tenants who pay all of my expenses, including utilities, and they pay for all of the mortgage. If I have a profit every month, then this piece of property that I have, or the apartments that I have, assuming that they generate a net income of, let's say, £800 combined, then this piece of property is appreciating in value, but also creating an income. So I wanted to make that distinction. The word appreciation is one that is very somehow strategic when investing in real estate. A lot of people make decisions on their choice of investment vehicle based on the word appreciation. So you want to buy stocks, you might say, well, it's £1,000 the share, but my stockbroker has said that it will increase to 1,200 within 12 months. That's an opinion. My real estate agent says the property is worth £1 million. However, based on what's sold around the area in the neighborhood, he believes the true value is £1,200,000. And all we have to do is buy it and wait for about 2-3 months. That's an opinion. A lot of people run into difficulties and challenges because they make their decisions to invest based on appreciation. Now, if you're making your investment decision based on appreciation, you've already violated a fundamental principle of investing. I learned something from a very wise man a number of years ago, and he said, you make your money when you do the deal. And if you have to force a profit for whatever reason, then walk away from the deal, because profits should come naturally. Appreciation is important to have an idea about what could the potential of the investment be in the future, but never base your decision based on appreciation, because it's based on opinions. The same way you have what we call positive appreciation, you also have negative appreciation. Negative is where the forecast goes in the opposite direction. So you buy a property for £1 million, and who knows, maybe in the same location there's been a huge increase in the availability of apartment buildings or commercial office spaces, and therefore the worth, the value of what you had declines. That could be negative appreciation. It goes down. So I want to talk about 2 parts of the appreciation process, so you can see how the right choices perhaps can help you. Number one, when you're about to make an investment choice or decision, but also when you've already made an investment decision. Now, the first thing I'm going to talk about is what's called active and passive appreciation. 2 separate parts of the same appreciation, you might say, model. Active appreciation is where you intentionally, you as the investor, you make certain maybe cosmetic changes, maybe some refurbishments. You invest time, energy, resources to improve the value of the investment. Passive appreciation, on the other hand, is where you do nothing to influence or improve the value of the investment. However, external factors affect either the increase or the decrease. Give you a good example of how this works. Let's say, for example, perhaps let me make this more personal. Let me take you back so many years when I made my first investment decision. My first investment was a 2-bedroom flat for 215,000, and I put down a deposit of 30,000. The bank gave me 185,000. After purchasing the property, all I did was paint. I painted the property. All I did was painted. And I painted the property myself. So I didn't pay someone else to paint it. I painted it myself. Within a 2-year period, I had someone come back and do a valuation on the property, and the property that I had paid £215,000 for had appreciated in value. The property was now worth just over £465,000. Now I'll talk about this same example and I'll use it as we go along today, but here is the point. I painted the flat. That's active appreciation. It helped the value, but the painting didn't make it £465,000. I would imagine, if I was to be honest, I would say just the painting. I didn't change the windows, I didn't change the doors. I would perhaps think, because it was a very relatively not well looked after building, by just changing the paint, my estimate would have been that maybe I would have increased the value by about 25,000, because after painting it, it looked very nice, it looked much bigger. It wouldn't have been any more than £25,000 compared to this, and this is based on what was available and all the other properties I had seen. In many cases, by painting a building only or a commercial space, what you can do is you can increase the value from about 10 to 25,000 just by painting. That is active appreciation. I did something to increase the value. But what happened really, the reason it went from 215 to 265, 465, was simply because the demand for properties in that area had escalated far beyond what I had planned or assumed. So it had nothing. The real appreciation had nothing to do with me. That is external events. Demand, supply, purchasing power of the currency affected the investment. Now, a lot of people make investment decisions on the assumption that it will appreciate, whether passive or active, and they make those decisions, unfortunately, without sound financial understanding. Anytime you're making a financial decision based on appreciation alone, then you're speculating. You're not investing, you're speculating. Investors don't speculate. You can study the trends, you can study the market, you can make your decisions based on sound principles, you can perhaps make an estimation of what it might be, but you don't invest based on speculation, because it's an opinion, it's not a fact. Now, one of the most important things to recognize is that between both of these, you have a word called control. Active appreciation, you have control because you can do things to the property, to the investment, to increase its value. When it comes to passive, because passive has to do with external events, you have no control. No control. And the less control you have over the investment, the less you should make your decision based on appreciation. Now, I'm going to switch very quickly and talk about a different investment vehicle. I've been talking about real estate, but how does this apply to other investment vehicles? Commodities, gold and silver. How does it affect paper assets, stocks, bonds, mutual funds? Let's assume you want to buy a stock or a bunch of stocks and mutual funds, and the broker says it's going to increase in value. You don't make your decisions based on a future event. You always make your decisions based on today. So the decision for today is simply, what's the value right now? Or what are the dividends I'm going to be getting? Going back to the example I used about the land and the house, if the house is paying me £800 per month, that's a fact. If the property is going to be worth an extra £500,000 in 5 years, that's an opinion. Always base your decisions based on facts. So if you're investing in stocks and you're going to get dividends, if you're investing in any form of investment vehicle, including real estate, the question is not what is it going to be in the future? It's what are you getting right now? A lot of people buy and sell, and a lot of people who perhaps run into challenges are those who buy with the hope. And here's the word here, hope. The word hope does not fall into the investment vocabulary because you're dealing with emotions now. And emotions are the enemy of good decisions when it comes to investing. You make your decisions, you do your thinking before it's needed, so that when you come to make the right decisions, they are consistent with perhaps your principles, your values, your standards. Hope, unfortunately, influences your decision making emotionally. So my recommendation number one is, in dealing with appreciation, always invest in an asset, in an investment vehicle, in a business, commodities, with the foresight, with the hope. I'm using that word now. Obviously, you've got to think long term. You're thinking long term, so you're hoping long term you would perhaps increase the value of your investment, but you don't make the decision. The hope comes in as a bonus. You make the decision based on what is worth today. Now, that doesn't mean you're saying you want instant gratification. No, what you're saying is, the first rule of investing is never lose your original capital. Number one. And if you go by that principle, you wouldn't make a decision hoping that it will increase in value. You're always thinking, okay, can I protect what I've put in originally? So the first thing I would say is appreciation. Invest in an asset that has the potential to increase in value, but more than anything, invest in an asset that creates income in the present, because that's based on facts. Now, the second thing that I want to talk about today is a concept of leverage. Leverage. This word is a very strategic word with real estate investing. As a matter of fact, the only reason that real estate is attractive as an investment vehicle comes down to two primary reasons. Number one, the use of leverage, and the use of taxes, which is also another form of leverage if you want to put in that category as well. Now, what is leverage? Leverage is simply your ability to do more with little input on your part. And there are four leverage options that make real estate investments very attractive. Number one is leverage of other people's experiences. We call that OPE, other people's experiences. There's also the leverage of other people's time, OPT. There is also the leverage of other people's money, OPM. And there's the leverage of other people's wisdom, OPW. Now, the four leverage options are incredibly important. I want to talk about one of them, but let me just quickly run through each before I focus on the one. Other people's experiences. There are two ways of learning. You can learn from your experiences alone, and that often comes from making mistakes, because success and failure come as a package deal. But success is a very poor teacher. You don't learn a lot when you succeed, but you learn from your failures, because failure is simply feedback. Now, you can learn from your experiences alone, which would be your failures and your successes combined. However, the problem is you're trading time, and this is a slow way of learning. Now, you could also decide to combine your experiences with other people's experiences. Now, just like you're doing now, you're combining your experiences by learning from someone else. We call that a process of using OPE. You can pick up a book and read a book, and in 4 hours of reading a book, you can learn what took the individual, the author, maybe 40 or 50 years to learn. Now that is using leverage, the power of other people. Very important. If you're going to invest in real estate, you cannot take for granted OPE. It's extremely important. We have 7,000 years of recorded history so far. In the 7,000 years, we've seen the good, we've seen the bad, we've seen the ugly. Some people have seen all of it, and they've documented their journey for other people coming behind. And if you can humble yourself, push out all all arrogance, and put on the garment of humility and say, what can I learn from other people? What you find that you can accelerate your ability to create wealth much quicker than someone only trying to get wealth using their experiences. You're never going to live long enough to try everything out yourself and then succeed. My recommendation is use OPE. Now, OPT is other people's time. In other words, you have a finite amount of time every day. Those who maximize and create wealth are those who have recognized that there are two ways of making money. Number one, you can work for money. In other words, you have to trade your time in exchange for money. Here we have money as the master and you as the servant, because you're working for money, but you're having to give your time for it. Or you can rotate the equation and have money work for you. You then become the master, money becomes the servant. But to apply this principle, you need leverage. You must use other people. Use other people's experience, other people's time, so that you can get more done with the limited time you have available. Now, the third is other people's wisdom. Now, wisdom in itself is a topic and a subject that has featured in every single session I've done. I'm not going to spend time talking about it, but in my opinion, I believe that wisdom is the foundation to all investment decisions. And all good investment choices are founded on wisdom. If you have a good foundation of wisdom, your decisions, your choices, your journey becomes a lot more bearable and also much better. But I want to talk about other people's money. And by other people's money, there are two aspects that perhaps are worth talking about. And I want to show you the importance and how those who are great investors and the wealthy, how they achieve a lot more, much quicker than the rest of the population. It comes down to the leverage of OPM. Now, OPM comes in two parts. The first part is what we call debts. The second is by using equity. But this equity is not from yourself, it's using equity partners. Primarily in real estate is debt leverage. Debt leverage. So let me give you a good example. Now just play this along and see whether it kind of makes sense. Let's assume you have £50,000 to invest. Let's also assume that you were able let me make it a little bit more. Let's make it 200 and let's just to illustrate, let's make it £500,000 you had to invest, and you were going to invest in real estate. Let's also assume you bought the property and the property has appreciated in value. And in this instance, let's just assume that in the first year, you're going to get back an in this instance, let's say a 10% return on your investment. You paid all cash for the property. The property was worth 500,000. You paid 500,000. Now, 10% of 500,000 would mean that you make 50,000 pounds. So, the total equity you have in the property at the end of the first year is 550,000 pounds. In total, the value of your investment has gone up, so you have an extra 50,000. Now let's also assume in this instance that you also have 500,000 to invest. As a second example, this is number B, let's call this A. But let's assume in this instance you want to use leverage. You've decided to use leverage. You go up to the bank and say, I want to get a loan financing for a property. The bank says to you, well, we'll agree on what's called an 80-20 loan. So they want you to put up some of your money, and for that they will probably be happy to loan or lend you what's required for the balance. Now in this instance, let's just assume that what you've gone for here is a property worth £2 million. And for the £2 million, you're bringing £500,000. You buy the property, the bank gives you £1,500,000, you put in 500,000. Let's also assume, like the first example, after the first year, you make 10%. Now 10% of 2 million is 200,000. So at the end of the first year, the person who used no leverage, they've used all of their money, what they have is an extra 50,000. You, on the other hand, you have 200,000. So your total equity in the property now is £700,000. Make sense? In the same way, if you decided, both of you decided to reinvest for whatever reason, you pulled out all, let's just say you were able to reinvest what you had. You have 50,000 equity in the property. If you wanted to reinvest that 50,000 using your money in an investment, you would have to put up the entire 50,000. In this instance, let's say you're going to reinvest 200,000. If you decide to use, again, an 80-20 ratio, the bank will be willing to offer you roughly about 800,000 to combine with your 200,000, so you can then acquire another property for £1 million. That £1 million property, when added to the original property you had, which is 2 million, you now have £3 million in investing in real estate. The person who decided to use their own money has 500,000 plus 50,000 in investing. Can you see the difference? So leverage in itself is something that helps you achieve so much more with very little. But as much as I want to demonstrate the power of leverage, I have to recognize, and I have to be honest and tell you as well, that leverage can fall on both sides of the equation. Leverage can help you become wealthy if you have wisdom. Leverage can also make you poor if you lack wisdom. Let's assume in this instance that you bought a property, like the same example, for 500,000. You put up all of the equity. You paid cash. The property declines in value after the first year by 10%. You get a negative appreciation. So after the first year, you lose £50,000. So the total equity you have at the end of the first year is now 450,000. If you took out a mortgage, having put in your 500,000, you took out a total, you paid for a property for 2 million, it declines by 10%. That means it's gone down by £200,000. So at the end of the first year, you have 1.8 in the property. Therefore, you've lost £200,000. So your £500,000 originally is now only £300,000 compared to the person who didn't use leverage. Now, this is just to show you that leverage can swing both ways. It doesn't always, create a positive return. You have to use wisdom. Now, what's the purpose of leverage and what's the advantage of leverage? It's quite simple. If you're going to invest in real estate, two things you should understand. If it's your home, the way you use leverage or debt for personal residence is very different to the way you use debt for an investment asset. The first thing I would say about using debt leverage is this. Leverage only respects wisdom. Debt only respects wisdom. Debt only finds integrity where there is wisdom. In other words, it's not about using debt, it's about using debt intelligently. There's something called you over leveraging yourself where you've used too much debt. You want to maximize the use of debt. However, you should only use debt to the level of your financial education and financial IQ. In other words, if you lack financial understanding, please stay away from debt. If on the other hand, you've committed to a discipline of daily, constant, never-ending growth, improvement, learning, study, then you must regulate your investment to suit your level of understanding. Let me make this more practical, bring it back to myself. I mentioned that my first investment was for 215,000. I put down 30,000. The bank provided 185,000. Before I started my investment journey, I had a plan. I had a plan for a 10-year period. I had studied the market very well. I had spent about 3 years studying. I knew I was going to use debt leverage. But here is the key thing. My study was and my pursuit for wisdom was what made me understand the advantage of using debt. But also it made me realize that amongst all the investment vehicles, bonds, well, I shouldn't say bonds, I should say paper assets, commodities, business, and real estate. My study, my increase in my financial education was what made me recognize and realize that debt leverage and OPM was very difficult to use with paper assets. It was very difficult to use with commodities. It was difficult to use with a business, but it was feasible with real estate. The reason is simple. The banks consider real estate to be of a lower risk than all the other investment vehicles. And the fundamental reason for that is this. It's the word control. I talked about appreciation previously, and I said, whatever decisions you're making in the future or concerning the future is an opinion because it hasn't happened. The banks recognize that paper investments, you have a lot of external influences. The investor himself or herself has little control. You take your money, you give it to a broker, or you invest in a company, and you cannot control the external market. You can be a sophisticated investor, you might know everything that is needed, you might study the market well, you might spend a lot of time every day analyzing the day and the trends of what's going on, but there are so many external factors that you have no control over. And therefore the banks will rarely ever give you money to invest in paper assets. Rarely. The banks will also give you little or nothing to invest in commodities because of the same principle. You're dealing with external events that the investor cannot control. And if the investor cannot control the investment, the risk goes up. So in relation to leverage and using debt leverage, the lower the risk, the easier it is to use debt leverage. The higher the risk, the more you should walk away from using debt leverage, because you're dealing with external events you can't control. Now, even with the business, the bank is reluctant to give a new entrepreneur a loan simply because they don't have any track record. The bank will need to have a collateral, something of equal or greater value to ensure that what they give you in terms of money, they don't lose it. The banks are never there to lose money. They're never in business to lose money. If you've ever watched any of the, say, Shark Tank or Dragon's Den or any of the TV programs where you have investors investing in businesses, one of the first questions they would always ask is, what are your sales? What were your sales last year? What are the orders you have for this year? What was your revenue? What was your profits? Because you can have great sales, but what was your profit? Because they want to see a track record that demonstrates that their money is not being put at risk. Now, based on the level of their risk, they might then offer you a percentage much greater than what you came to ask for. So you might say, I have a business and I want, say, £200,000 and I'm willing to give up 10% of the equity in my business. And they look at the risks and they say, no, based on what you've done so far, the performance in the past, we'll give you the £200,000, but we want 25% because the risk is greater. In using debt, you always have to stop and ask yourself a simple question. What's the risk profile? If the risk profile is low, it's more bearable. So I studied for a number of years and I found out through my study that I could use debt for property. Now my plan was very simple. Watch this. My plan was very simple. In the 10-year period, I decided I would buy my first property. After 2 years, I would apply a principle that I'm going to talk about next, called velocity. I would reinvest. I would pull out my money. I'll get another property. I will wait maybe another 2 years or 2.5, 3 years. I'll pull out the money again. I'll buy another property, so that by the end of the 10 years, I had a target when I started that I wanted about 5 properties using debt. Now here is the beauty of debt leverage. At the end of the first period of 2 years, the value of my property had gone from, so technically my net worth, which I had started with 0, I did have 30,000, but initially I had started with 0. I was able to get 30,000. I put in the investment property. After 2 years, the value went up. My net worth had gone up by just over $250,000. So I went back to the bank. I had a choice at that point. The banks will normally give you 75% of the difference between the new value and your original loan. For the sake of simplicity, I'm going to disregard any payments I had made in the 2-year period. So the bank was saying, listen, we can give you 75% of $350,000. Let's just call this 250 to make it simple. But I didn't pull out 250,000, because if I had pulled out 250,000, that would have meant that I would have had 250,000 available now to reinvest. But also, in the first property, I would have now had 465,000 in debt. In addition to that, if I took this 250,000 and I invested in the property, another investment, and let's assume the bank agreed to an 80-20 split, then I would have been buying a property of £1 million. I would have put in 250,000, so the bank would have been giving me £750,000 in debt. Here is the point. At that state, had I gone for this option, I would have been £1.215 million in debt. £1,215,000 in debt. Now there's a problem with that. I'd only studied for 3 years. I was studying every day still, but that was way too much leverage. But more importantly, I didn't have any other income streams sufficient to maintain this level of leverage. Something had gone wrong. Obviously, you buy a commercial property, you want to lease it out, but what happens if your tenants can't pay for it? The bank still wants, the expenses are still there. Your income might stop, but the expenses are still there. So in using debt leverage, there are two things you've got to recognize. Number one, you must have other sources of income that guarantee that in the event that there's a catastrophic failure or something that stops the income flow, you can still cover the expenses. That's the first thing. The second thing is you must choose a level of debt leverage that matches your level of understanding. At this point in time, I hadn't developed my financial intelligence to be able to use £1,200,000 for investing. With debt, it was just too risky. What I did, however, was I went back to the bank and I said to the bank that I want to pull out my original £30,000, which the bank was happy to give me. That meant that I now had equity in the property. So the 250,000, which was my equity now, plus my original £30,000, meant that I had £280,000, hypothetically speaking, because it's an opinion. I wasn't selling the property, so it was an opinion. The £280,000, I took 30,000 from it. I left the 250 in the property. Then I used this £30,000 to go through another transaction, much bigger, however, but I was only using much less. I was using a little amount of debt leverage. I was still buying another property of the same, within the same range. It was more expensive, but it wasn't for 1.2 million. It wasn't rather for one. I wasn't getting myself into a total debt of 1.2 million. Now, I hope that makes sense. The point is this: if you're going to get into real estate investing, you've got to use debt leverage if you're going to invest. Now, part of the reason that I suggest using debt is, I should point this out very quickly before we move on, is this. Money has a purpose. Money has a purpose, it has a function. The purpose for money is for it to continue to reproduce itself. You should never take your money and put it in one place and let it stay there. Because money, what we call currency, depreciates over time. So, let me use this as a good example. If we assume the first person buys a house, buys a home, and they have 100,000 equity in the home, and they leave the 100,000 equity in the home, in 10 years' time, let's disregard, for now, disregard appreciation over time, but in 10 years' time, this £100,000 will be worth less in purchasing power. It will be worth less. A good example is using the principle called the rule of 72. The rule of 72 is what I call a rule of thumb guide to understanding how quickly your investment will double in value. So, for example, if this property was appreciating by 10% or producing a 10% return, then you would say that 72 divided by 10, 7.2 years, the property would double in value. The rule of 72 can also be used to calculate how quickly your money can decline in value. Now, in 2008, the inflation rate was 2%. The inflation rate today is 2.9%, so you can see the change. In 2008, 72 divided by 2 would have meant that in 36 months, the purchasing power of the money we had then would decline by half its value. This is a rough estimation. In today's terms, if we call that 2.93, it would mean that in 24 months, the purchasing power will decline. So the point I'm making is this. Money has one purpose. You want to put your money in an asset that appreciates in value but also generates an income, or you want to put your money in something that continues to multiply itself. So taking your money and putting your money in a building and parking it in the building is not financially smart for a number of reasons. This property could decline because it's based on external events that you have no control over. For example, good example, let's assume the way you've purchased this building, that there's always been a demand. But let's assume that a new construction company, a developer comes in and they decide that they have so much money they want to invest. They're going to be constructing new buildings and maybe 1,000, 2,000, 10,000 buildings. And let's assume that just their construction efforts increases the availability by 20%. If previously the demand supply was almost even, in other words, there was just about enough properties for the people who wanted them. By putting an extra 20%, what you now have is a surplus. You have more properties available and the demand is lower. It works against you. To the buyers, great, because they can bargain. To the owners, not so great if you're thinking about selling. Now, even if you're renting, it's still a problem because the renters have more options. So this property you have here can decline in value, but it can also incline in value. But you're dealing with a future event. So we disregard appreciation. We ask the simple question, what will be the value of the £100,000 in 10 years? It'll be worth less. So when it comes to property investing, you want to use debt. There's an exception to this if you're dealing with your personal residence. Obviously, that's your personal residence. You might have a different view. But when it comes to investing, you want to maximize debt for a number of reasons. If this property declines in value, if you had gone for a leverage agreement with the bank of 80-20, then you're taking 20% of the risk. The bank is taking 80%. So you're protected. So debt has a way of protecting the investor. But also, because you're using debt in 10 years' time, debt doesn't decline in value. As a matter of fact, debt even becomes more attractive with time. As opposed to using equity. Your equity declines in value, your debt remains. It remains. So my recommendation is this: if you're going to invest in property, educate yourself first, because it's a very interesting game. There are rules, there's a vocabulary, you have to study both. But educate yourself first and study the use of leverage. But if you're going to use leverage after study, always make sure that you don't over leverage yourself. Let your use of leverage match your level of financial IQ. If I go back to the example I gave about myself, I went through a process of study. After my first investment, I pulled out my money, but I spent some time in between studying. I was studying in between the period, but before I made the next commitment, I went into study. Again, because now I was increasing the level of debt I had, and I had to make sure that it was right. Now in studying, you need about 3 things. You need good mentors. You need a good financial advisor, and you need good association. But I'll ask you to do something as well. You need to invest in what I'll call your mind. Books, audio programs, seminars, webinars, conferences, anything you can to increase your understanding. Now, I spent a lot of time talking about leverage, but I think it's important. Let's move very quickly now. Let me talk about a concept that I think will be interesting to a few people. Anyone who has studied economics understands the word velocity of money. It's a very simple concept. It simply means if I have a pound, how quickly can I use the same pound and go through a number of transactions within a specified time frame. So for example, if I have £5 and I spend £2 down at the bakery, and then I spend £2 at the butcher's shop, and I spend £1 with the farmer. Let's say the farmer produces some fresh oranges. I bought some bread, I bought some sausages, and I bought some oranges. I've distributed my £5 evenly, well, not evenly, based on what I wanted. Now, if the baker in turn decided that he was going to spend this £2 at the farmer, and if the butcher decided to spend his £2 at the baker's, and if the farmer decided to spend his £1 at the butcher's, what we have now is what started as £5, my £5, we've spent £10 in total, because the money has circulated and is moved very quickly from one hand to the other through selling or through exchange of goods and services. So what we say is the velocity of my money is £10 divided by £5. It's got a velocity of 2. In other words, how quickly is the money moving? Very simple concept. Every single economy, every single country, every single business runs based on the velocity of money. Cash flow, money coming in, money going out. If a country, for example, go through a period of no spending, the economy declines, because without movement, there's no life. You know, your heart has to pump blood through your body. The blood is going all the way. You have to breathe in and out. That's movement. Nature's second law is movement. You need movement. So in investing in real estate, one of the concepts that is important is something called velocity. Now, the velocity of money is something that we've partially talked about so far, but let me bring it in such a way that you can get it and see how you can apply it in your personal life. Now, let's say, for example, you have £50,000. You found something to invest in. The bank is willing to give you £450,000. So you buy a property of £500,000. Let's assume you've gone for what we call maybe a 2-year fixed period. And in the first 2 years, maybe your repayment loan is 1.9%, and it goes up to 4.9%. This means you pay 1.9% of what you owe, or what you've loaned, for the first 2 years, and then it goes up to 4.9%. The velocity of money is used strategically in this way. After the first 2 years, you go back to the bank and refinance. Now, let's assume that for this arrangement you have, the bank, based on your total loan amounts, the bank said that your mortgage every month was $1,500. This is investing now. This is not your home, it's investing. $1,500 you pay for the first 2 years, and then it goes up. What you do is, after the first 2 years, you go back and you renegotiate. This is where we bring in appreciation, which is what we talked about previously. Let's assume that in the area that you're talking about, that the value of properties has gone up by 10% in the last 5 years. So after the first year, your 500,000 property has gone up to 550. This is year one. By year two, the 550 has gone up by an extra 10%. So you have 550, let's assume it's gone up to 555,000. You go back to the bank after 2 years. You say to the bank, listen, I want to refinance. The bank says, we're going to give you 75% of the difference between the new value and the £450,000. So in this instance, you're looking at 100,000. $75% of this will give you something in the region of, say, 82,000. Forgive me if the numbers are off, but you get the mess. You get what I'm trying to get. It's probably about £82,000. This £82,000 you pull out from the investment. A lot of people have a conception or misconception that you can just pull money out of the bank and the bank gives you the money and that's okay. No, you've got to apply some wisdom here now. For £450,000, you were paying £1,500. So the bank would always recalculate your loan repayment based on what you have as the new loan. If you pull out £82,000, then your new loan amount is 450 plus 82,000. So you now have £532,000 as your loan amount. So that goes up. So the important question you ask yourself is, can I still make a monthly income, net profit, and pull out my original investment? The bank is willing to give you £82,000. The question is, should you take £82,000? Rule number one, never lose your investment. Capital, never. Rule number two, never make a loss. So what you do here is you go back. Now let's assume in this instance that you have this rented and you're making 1,800. So you're making £300. The £300, on the other hand, doesn't include utilities. Let's say when you've paid off all your utilities and expenses, you have 150. The strategic thing to do is go back and say, how much can I still take as a loan but still make a profit? In this instant, you might be happy to reduce your profits to £50. That's all you take, and this £100, you're happy to offset that through an increased loan. So this might mean, based on your calculation, you have to work out the numbers. You might come to a decision that you can only take out £60,000. For that £60,000, the bank might suggest that you pay maybe 1,650, for example. This will now mean that you're only making £150 from the deal. If your expense is 150, then it means you have nothing. You might adjust it and say, okay, well, can I get a better deal from the bank in terms of the interest, such that I can still make £50 per month? If the answer is no, you can go back to the bank and say, I don't want to take 50,000, because you're doing all of this works before you agree on terms. You might go back to the bank and say, I want this to be £58,000 instead. At £58,000, the bank might say, okay, that's £1,600 per month. No problem. At £1,600 per month, you have £200 balance. 150 goes to utilities and expenses. You have £50,000, £50 per month. So every single year, from that investment, you're making £600 annually, net profit. You pull out £58,000 from the investment. This now means that in this investment, you have nothing invested. We call that an infinite. You're now getting an infinite return. So there's something called your yield. Your yield is simply your net profits over your investment capital. So in this case, you have £600 per year divided by 0. That's infinity. That's where the word infinite return comes from. So you now have an investment whereby you have nothing invested in it. It's yours. You know, things being good, it might appreciate in value. Doesn't really matter. You have debt leverage. But what you have now is a property that pays you £50 per month. And one of the things I didn't include, although I used 10% appreciation in the value, I didn't apply the 10% appreciation to the rental. Obviously, the beauty about real estate is that is indexed for inflation. So you're on a year-by-year basis, the increase in rent will always be greater than inflation. So if you were getting £1,800 in the year initially, if this went up by an extra 10%, just like this sale value, then it would mean that by the end of year 1, it would be renting for £1,910. Again, by the end of year 2, this would have been renting for roughly about £2,090. So the numbers here increase as well, but it does require some level of study. The point is this: you pull out your £58,000, you have your £50,000 back, you have an £88,000 extra for your hard work. You take this £50,000, maybe you set aside £8,000 maybe for yourself, or you might decide, I'm going to make this up, I'm going to make it £60,000. You go back to the bank and say, I found another property, I want to invest. The bank says, we're happy to support your investment decision, so we'll be happy to give you the funding you need. Let's assume you find a property, you put in your 60,000, the property is valued at say 500,000. You go through the same process again. This time around, let's assume that it doesn't take 2 years. Maybe you have to wait out another extra year, so it's now 3 years. In 3 years' time, you go through the same process again. By the end of the 3rd year, you pull out your original £60,000 again. You assume that maybe all you're getting is an extra £50. For the second investment, you have 0 invested in it. But what's going on here is this. Watch this now. Watch this, and this is so interesting, but also so powerful. Let me just take this all out. If you had the first property, which is 500,000, and the second property, which is 600,000, at the end of 5 years, you now have an investment portfolio of 1,100,000. A lot of that is debts. A lot of that is debts. If from the second property, because you put in 60,000, if we assume that you have £540,000 in debt, and the first one, you pulled out your 50,000 anyway, you have 500,000 in debt. You might be thinking, what's the advantage? I've only got £40,000, because you might be thinking the difference is this. So I've only got £40,000. Technically, that's not true, because what you do is you apply the velocity of money again. But also, let me make this practical by showing you the value. Although you do not apply appreciation in making your investment decisions, you must use the gift that comes with appreciation strategically in securing and using debt leverage. What does that mean? Let's deal with the first property after the first year. If we were simply to apply a principle, I'm going to show you 2 options of how to do this, but if we were to apply a principle that I talked about earlier on, which is the rule of 72, if the property has increased 10% every year. And the trend suggests that it will be the same in the past 10 years. What you simply do is you divide 72 by 10. This means that in 7.2 years, the value of the property would have doubled. So this property for 500,000 in 10 years could be roughly in the region of about £1 million. Likewise, that will be in the region of about £1.2 million. So now you have £2.2 million in investing. You might look at that and very quickly say that's not possible. Hang on, because it is. In 10 years, a 10% is going to, in 7.2 years, is doubled. What we're dealing with here is 5 years. So we might just say, okay, well, let's see what would happen when you're about to make the third deal. It's gone up to 2.2 million. Your investment debt is 1.4. So in 5 years, it's very easy for you to increase your net worth by up to £1 million. A lot of people might say this is not possible. So watch this now. Let's deal with the first property, 500,000. At 500,000, if we were calculating at 10% increase every single year, at 500,000, at the end of year 1, we have 550. At the end of year 2, we have 605. Year 3, we have 665. Year 4, we have 732. Year 5, we have 805. Now let me just put this asterisk here so you will come back to this. By year 6, we have 885. Year 7, we have £974,000. Now compare the 974 by the end of year 7, so 5, 6, 7 to 7.2 years of 1 million. So you can see you're not very far off in using the rule of 72. It gives you an idea. But check this out now. If we were simply to use this £800,000, because we're dealing with 5 years, it means that in 5 years, you have a debt of £500,000 in the first property. The value of the property is at 805. So you have about £300,000 equity in the property at the end of 5 years. For the second property, it's slightly different, because in the second property, with the first property, you've actually gone through 5 years. With the first property, let's assume that you refinance after 2 years. And with the second property, let's assume that you didn't refinance after 2 years, that you perhaps waited until the third year. So with the first property, you have 2 years, and with the second property, you have 3 years. So for 600,000, after year 1, the value is 660. At the end of year 2, it's 726. And at the end of year 3, it's 798. So by year 5, the value of this new property would be 796, but you have 540,000 in debt. So less 540,000, it means that your second property, you would have 258,000 in the second property by year 5. 285,000 plus 300,000 would mean that you have a total net worth of £558,600. But guess what? All of this money that you've accumulated or created has come as a result of using debt and leverage and using the velocity of money, because, let's be frank, go back to the beginning. You started by putting in £50,000. Your £50,000, you pulled it out after 2 years. But when you pulled it out, you pulled out more than 50, you pulled out £58,000. Doesn't really matter if we call it 50. At the end of the 2-year period, you took the £50,000, you put it into another property, and then after 3 years, you're going to pull it out again. But by using debts and using the velocity of money, by the 5th year, the £50,000 you started with has created a fortune for you of £500,000 and more. You have £558,600. First investment, you put in 50. Second investment, you pulled out £58,000. So deduct £58,000. You have, by using the velocity of money, by using debt leverage, you have increased your net worth by £500,000. That's how simple it is. That's how simple it is. So all you have to do, first of all, if you're going to invest, is have a plan. Real estate doesn't make you wealthy. Stocks, bonds, mutual funds do not make you wealthy. A business doesn't make you wealthy. What makes you wealthy, first of all, is the plan. Secondly, most importantly, is the investor, your financial education, your financial understanding. Now, guess what? You can continue this leverage, because that's how it works. Depending on how brave you are, assuming that you have other sources of income that can far cover, potential loss of earnings, you can maximize more debt leverage, and you can go back and pull out this, what may have been the appreciation from property 2, you can use it for a third property, and what you find that in a space of 10 years, it's very easy for you to become a millionaire and even much more. The key here is very one thing to remember, and the key to all of this is simply integrity with yourself. Debt is great, but you need wisdom. You need to study. You shouldn't use leverage to the extreme, because leverage can swing both sides. But also, if you're using leverage on the basis that you're going to be leasing or renting, then you have some protection, providing that there's always going to be a demand supply in your favor. So in addition to having the education and the understanding, you also have to have the entrepreneurial mindset to look far into the future, use your vision and see what could potentially go wrong, but also see opportunities. Now this brings us very, very nicely into what I want to talk about next, which is strategic in maximizing your returns. I'm going to talk about income allocation. Income allocation. Because if you're going to maximize cash flow, remember this, every investor investing in real estate is only focused on one thing: income. By this, I'm not talking about investors who buy and sell. They have a completely different model. That's a different model. I might talk about the advantages of buying and selling over buying and keeping. The key thing is this, from my little experience, if you want to create wealth through real estate, you do not buy and sell. You have to buy and hold. You've got to buy and hold for the long term. That's how you really build wealth. But in buying and holding, you must focus on investment income, maximizing the income you're receiving. You're relying on long-term appreciation, but that is not your main reason for investing. You're investing for income. Part of the reason you're investing for income is because of cash flow. If you can get cash coming in, then you can maximize the use of debt. You can use leverage. You can't use the velocity of money. Now, let me share something with you in relation to income allocation, because this is where the juice really lies. It's not about how much money you make. It's not about how much you generate in revenue. It's not about how much you generate in sales. The question is, how much of what you're generating are you keeping? So you could generate a lot of revenue, but your expenses are too much. Think about this. If you have a company that has 100 employees, and they generate £1 million in revenue, would you rather have this company or another company that has only 10 employees and they generate £1 million in revenue? Of course you would want that, because the expenses are much less, so you can make more of a profit compared to this. So with investing in real estate, because you're focusing on investment income and less about appreciation, obviously the appreciation you take advantage of because you're using debt. Once you see that the value has gone up, you pull out the money through debt. Part of the reason being, the reason you're recycling is what I like to call the term. The reason you're recycling your money is because with real estate, when you use debt, you don't pay taxes. Say that again. Perhaps I should spend some time and just clarify what that means. If I, for example, decided that I wanted to buy a property for 100,000, I bought the property and I sold the property for 200,000. I now have what's called a capital gain or income of 100,000. I have to pay taxes on this. I have to pay taxes on the income. If I bought a property, on the other hand, for 100,000, now watch this. This is quite interesting, and it went up in value by 200,000. With this, you're talking about people who buy and sell. I'll call it buy and sell. I'll call this buy and lease. If the property goes about an extra 100,000, then I have 100,000 in equity in the property. Assuming the bank is happy for me to take the 100,000, with this option, if I assume a 20% tax, just as a rough estimate, 20%, after paying my taxes, I will have £80,000 left as my net profit. With this option, using debt, because this is debt still in the property, if I pull out this money in debt form, the bank will pay me £100,000. However, I pay 0% in tax, so I'm going to get £100,000. That's the reason why buying and selling is not really a smart way to invest in real estate, because one, you're dealing with instant gratification. Now, buying and selling is fine if you need income. Maybe if it's a business, you need income, that's fine. Maybe you want to make your profits, your stakeholders, your shareholders want their profit, that's fine. But it's a very inefficient way of creating wealth, because you're simply doing the same thing all over and over again. You buy a property, you sell, you make a profit. You go and buy again, you go through the same problem, you sell, you make a profit. This person who is buying and holding can pull out the same amounts that you're taking in profit, but they still have the investment. And this investment is still generating an income every month through tenants, but also this property or investment they have, over time, if it appreciates in value, they can become really wealthy. That's where wealth is created. But they can also take this £100,000, use leverage and buy another property. So they're simply recycling. Now let me stop there and come back to asset allocation, because I want to talk about something that I think is important and strategic. Like I said, it's not how much you're generating in income, it's your expenses. Strategic management is required for real estate investments. Strategic management. Strategic management simply means you maximize income and you minimize expenses. Now let's start with the first. How do you maximize income? Let's go back to the reference that I made at the start. If you have an investment that you are controlling, then it means that you can decide, you can influence the income that comes to you. For example, you have a property, you have tenants as a commercial building. What are the things you can do to maximize the income? You paint it, you put in a new heating system, a new cooling system, perhaps you refurb the building. That can maximize income. Or it's a big building, for example, rather than you renting out to one tenant, you subdivide the property, you now have 4 tenants. If the original tenant was paying 20 square meters, £20 per square meters, for example, when you split it into 4 people, you might, because it's now smaller, you might have a situation whereby you are able to charge £25 per square meter. That's how you maximize income. It's simply you using active measures to force your income flow to increase. Very easy. If it's a residential building, for example, it might be a case of perhaps doing some cosmetic changes internally, maybe providing an extra space externally, but you do whatever you can do to increase the income that comes to you. It's less about the increase in income, it's more about minimizing expenses. That you can influence to an extent, the expenses you can influence directly. To minimize expenses, the few things you should consider, and this is where I would normally suggest people become a little bit more entrepreneurial in their approach. Let's assume you make £1,800 as income. Let's also assume your mortgage is £1,200 expense. So you'd have £600 left. But you haven't allowed for utilities. Now, the mistake most people make in doing real estate assessments, now what we're doing here is showing you what you must do before you start making an investment. You've got to do a lot of these assessments first. The mistake most people make is assume that this is profit, but it isn't. Because you must allow and set aside a level of contingency to cover a number of utility expenses. For example, you might have what's called vacancy. Vacancy. The property could be empty for a few months. What happens if it's empty? If it's a commercial building, going back to what I talked about, if it's a big space, it's a lot more difficult to rent than if it's smaller spaces. But you might have vacancy. If it's a residential, you might have vacancy. So you have to allow a allowance for vacancy. You've got to allow an allowance for insurance. You've got to allow provision for maintenance. And this maintenance is preventive maintenance, but also repairs if something goes wrong. You've got to allow for your taxes. You've got to allow for your management fee. And what you might find is that this £400, £600 you have, when you've made all the provision and the allowances, you're having to deduct an extra £400. So in estimating whether a deal might be right for you, this is the key thing to consider, because you're dealing with income. It's how much is the net income that I have. If after doing your assessment you find that although you make much more in income than your mortgage, but if you find for whatever reason that the total amount you're paying or having to pay is say £600, then it means that you're making zero net income. This is a questionable investment for you. Now, obviously, you have to make a decision as to whether you can sustain the investment maybe for the first 2 years and then refinance and hopefully things go up. My opinion would be it's a no-go. It's not a deal for you because you're losing money from day one. You've got to walk away from the deal. But the only way you can understand if it's a good deal for you or not is if you understand all of the various contingency provisions you must account for. Now, here is where real estate becomes quite interesting. There are two ways you can invest in real estate. You can invest as an individual or you can invest as a business. If you invest as an individual, the first thing you must understand is that you must pay taxes first before you take your profits. You have to pay taxes first before you take a profit. As a business, on the other hand, you pay all of your expenses first, then you pay your taxes. So let me share something that I think is probably quite useful. The business has the advantage of paying all expenses first, then they pay their taxes. Using the same example we were using before, 200,000, 1,200 is mortgage, income, £600 is what you're making, Let's assume in this case that your total utility expenses and all your miscellaneous expenses was £600. For example, let's just assume that. But you've made £600 as a profit. Let's assume you pay 20% tax on this amount, on 600. 20% taxes you're paying. So that's £180, £120. So you're left with £480. But by the time you deduct your utilities, you're down to a loss of £180 per month. You're making a loss. This is where people who are in real estate as a business have more of an advantage than individuals. Now, if the same cost assumptions were applied to a business, the business has 1,800 income coming in. The mortgage is 1,200. £600 is what's left. The business, however, in this case, now remember this, I gave you a list of options of things to consider. I said vacancy. So as your vacancy sum, for example, if you assume the 10% vacancy, if you were making £1,800 per month and you said allow for 1 month vacancy, so every year you say, well, maybe things might go wrong and the property is empty for 1 month, it means you're setting aside £180. But it doesn't happen every month. But you have to make provision by deducting the amount. Now, the smart way to maximize your gains is this £180 is vacancy. You might have insurance that you pay for. You might have maintenance that you allow for. Maybe 10% maintenance you set aside for, another 180. But your maintenance is not occurring every single month because everything is functioning. It might be perhaps periodic breakdowns or preventive maintenance that you do every year. So you have £180. Also, it could be a case where you say, in addition to this, I have made an allowance to cover unforeseen circumstances, say repairs. You might say, well, I've set aside £50. And what am I trying to show here? You might be putting aside maybe something in the region of almost £400 from this 600 for events that might happen. Now, this £400 is income. It is income. But if you're working as a sole individual, you will pay taxes first. The business, on the other hand, can afford to pay all of this, what might call, expenses that are not real. They might be able to pay all of that. They might be able to account for it to be £600. Therefore, they have nothing as profits. Therefore, they pay zero taxes. That's how the business gains much more. But here is the beauty there here now. If you've established this in a beautiful way, like anyone who is trying to provide protection to themselves, if you are dealing with your personal finances, you would have what's called an emergency fund. So you might set aside between 6 and 12 months as your expenses set aside. You might also have a fund for a business where you call protection to cover insurance damages. And in this case, you might set up maybe 12 to 24 months of income. These are things you still need in the business, but you don't have to have it in cash. Because it's real estate, you have two options. You can deal with cash or you can deal with debt. So a business, for example, might decide, well, we don't want to keep that £400 for vacancy, for maintenance. We don't want to keep it in cash. We can get that by debt if we need it. So the company might decide, okay, well, let's get a credit card that covers 6 months for emergencies, maybe another 24 months set aside in the business account through a credit card that covers insurance breakdowns, etc. they're using debts rather than using cash. The person who is investing as an individual may not have that level of debt availability in terms of amount, because this amount for a company can run into, the hundreds of thousands. But a company can generate that because they can demonstrate cash flow from the business. An individual, on the other hand, because you're just an individual, you may not be able to do the same. But here is the beauty. This is the beauty. The company declares zero profits, pays zero tax. The smart companies, however, recognize that £400 of the 600 is available because you're setting aside that as for future. But they don't want to keep this in cash. They go and get a credit card or have their credit loans or credit avenues should they need it. What they now do, rather than pay the mortgage of £1,200, this £400, they pay this £400 back into the mortgage. Now remember what I said. I said you want to maximize debt and leverage. I hope this is coming across clear. I think this is so important, I should say that again. £1,800 is income. £1,200 is mortgage. You have £600 as what would normally be your profits. Out of the £600, the company sets it up in such a way that 600 is set aside as expenses so that they pay zero taxes. However, out of the 600 expenses, £400 is money that is being set aside for the future. So they're only paying £200 in expenses. But because they don't want to pay taxes, what they do, this £400, they set up in such a way that they secure this £400 through other credit streams. They pay this £400 back into the investments so that what they're paying is £1,600 now for the mortgage. So they're overpaying on the mortgage. Now here's the point. When they take out their mortgage, they may have taken out a mortgage based on principal and interest. Now, by principal and interest, it might be that in this case, for example, if this was a £2 million project and the principal here was £1,800,000, and if we assume that the loan was £1,800,000 and they put down £200,000 as deposits, but because they've gone through a long-term loan, 30 years, it could be that this 1.8 million, the bank says that they will have to pay back this in total in 30 years. They might have to pay 4.7 million. By making £400 every single month, this goes towards the principal, so it's reducing the principal, therefore the interest they're paying reduces. But here is where it gets really clever. External conditions and passive measures, together with the active measures they're putting in, makes the property appreciate in value. But also, because they're paying more, they have more equity in the property. So they might wait for 2 years, 3 years, 4 years, and they pull out extra cash from the investment. The extra money they're pulling out would have been this £400 they should have paid, part of it in taxes. This is just using debt leverage. The point I'm trying to make is most companies have this ability to pay 0% in taxes because they have a lot of tax advantages and loopholes they use to create more wealth. So they repay what they would have had as profits back into the business, back into the investment, and then pull it back out as debt. So they pay 0% on the books for their profits, and by pulling it out, they pay 0% again because they're pulling it out as debt. They accept that debt principle because someone else is paying off the expenses. So for the company, they're maximizing their leverage. They're using velocity. They're using other people's experience, other people's time. and they're getting wealthy much quicker, and they're paying 0% in taxes. Now that's a principle that is probably worth studying in a little bit more detail, because although it applies to a business and the tax advantages favor the business, as an individual you can still use some of the strategies. You may not get all the benefits, but you get some of it, but that requires study. Now, I hope that's been useful. I did go much longer than I would have wanted, but I think that's where I'm going to stop for today. Let me summarize by saying three things. Number one, if you're going to invest in real estate, you have to understand leverage, the use of leverage. Number two, you have to understand the velocity of the money you've invested and how quickly you can get that money moving. Number three, you must understand the importance of appreciation of your investments, but make your decisions without basing it on appreciation of the future. You must make your decisions based on the present. Those are the three important things. But if you've then made your decision and you've acquired an investment, an asset, portfolio, or business, you must now focus on income allocation, so you understand how to very carefully maximize what you're getting back in your return. I hope that's been useful. Let me wish you the best of luck. God bless.